Today's video, we're going to look at a range of different assets. We're going to compare them to gold and silver, how they performed in 2023. I've got some real world examples for you, and I've made a little bit of a table to make it a bit easier to illustrate. So you'll see here we have gold, we have silver, we have them in USD, and we have them in British pounds. So over on the left there, you'll see a column called yield. So gold and silver don't have a yield because they're not generating any interest or any dividends or any rental income or anything like that. We're purely looking at capital gains or losses in silver's case for 2023. So in pound terms, we had a 5.6% gain, in gold. In silver, we had an 8.3% loss, so it lost value over the year. And for US dollars, we had a 13% gain in gold, or a 2% loss in silver. Now in the tax column, I've written maybe because in the UK, if you're buying Britannias or sovereigns or things like that, then there are certain coins that are capital gains tax exempt, and therefore you wouldn't pay any tax on those gains. And in terms of pros, obviously it's a physical thing, so it can't just be evaporated away like some of these paper assets, and people who have concerns on those, you don't have to worry about that sort of thing. Gold and silver, I'd say gold mainly, is relatively stable. Silver is perhaps a bit more volatile, but gold is relatively stable and in times of crisis tends to do okay. In terms of cons, obviously it's a physical thing, so you've got to buy it, have it either delivered or stored somewhere. You might be paying extra for storage. I pay for a safe deposit box just because I feel more comfortable storing my gold in a vault. And people do think if you don't hold it, you don't own it, but it's still there now, and we're doing okay. Next up, we will look at premium bonds. So in the UK, these are basically a bond that are backed by the Treasury. They don't pay a regular yield, they don't pay an interest, but what they do is insert you into a lottery every month. So you could win £1 million, or you could win £25, you could win something in between, or you could win nothing. Now, the rate is variable depending on the Bank of England's interest rate. Currently, the rate is 4.65%. It is due to drop, though, into the next draw in 2024. And throughout 2023, it did rise. So it did start lower, I believe around 3%, and then rose through the year. So, you might have got around 4%. So you're only allowed to put £50,000 into the premium bonds, and once you've hit that, you can't compound or anything like that. You can't add any more in. The benefit of that as well, it is tax free. You don't pay any tax on those compared to something like a savings account, which might have been a slightly higher yield at the start of the year, but you would be then paying tax on that depending on your earnings level. So the cash ISA is basically a tax-free version of a savings account. You can also have a stocks and shares ISA in which you can buy stocks and shares. But again, the rate for the cash ISAs has gone a little bit higher since, but early in the year, you're looking at like 3 or 4% if you're tying your money up and not making regular withdrawals. But again, it is tax free, though you can only put in £20,000 per year. Obviously, over the years, though, you could accumulate quite a balance in there, and again, it would still be tax free. So next, we're looking on to some stocks and some shares. So we can see the S&P 500 had a very good year at around about a 24% gain. The FTSE All World basket of shares is a bit more diverse in terms of countries. Some people prefer that for that reason, and that managed a 12% gain. So again, that's a capital gain, and we can see you could have had a small gain in terms of yields as well, so some dividends from holding the ETFs, and they could be taxed depending on how you hold those shares and what type of account you have. So in the UK, if you have a stocks and shares ISA, then holding whatever they are in there would be tax-free. You wouldn't pay any gains on the yield or on the capital gain. So if you're holding them outside of the ISA, though, then you obviously would. And again, that depends on your income level. So next, we'll look at property. And property, I've got an example here of buying this particular house. It's listed at £110,000. It's an average little small family house. If you were to buy this and then spend around £10,000 in probably your conveyancing fees and just a bit of decorating, perhaps a bit of tiling work and just, tidying it up a bit, making it a bit nicer, bearing in mind I haven't viewed the house, but just to give you a rough example, and here's one that is rented out in the same area for, is it £835 there per month. So you're looking around about £10,000 worth of rent for the year on around about £120,000 worth of investment. Now, with this, again, you could have problem tenants. They could trash it, they could burn it down. You know, you can obviously get insurances and things. You've got various moving parts in there if you're paying somebody to manage the property for you. We've got regulations in the UK, so you need things like gas and electric checks and tests and certificates and things. And again, you know, it just depends on what you're doing with the house, whether you've got leverage, so if you're paying debt and paying interest on that debt, then again it will eat into your margins. And of course there is plenty of tax on that, so depending how you structure your property portfolio, whether you've got it held in perhaps a limited company or in your own personal name, it will dictate how things are taxed, how you can deduct expenses and so on. So there are a lot of moving parts in there, but you could quite comfortably expect to get a 7% gross yield on your property. And in the past year, according to Rightmove, the property prices on average gained by about 0.7%. So not quite a whole percent, basically flat for the year. You know, they have risen quite dramatically in the last few years. They were just a bit flat over the past year. So again, different assets perform different times. Some will obviously kick out a bit of yield, a bit of cash flow, and others it is simply a case of waiting until they are sold. And some do both, some don't.